Let's talk about the golden zone and how we use it. Hello, hello, this is Spooky's Revenge. We're back with another episode of the $500 5-year Rags to Riches series episodes. There's a string of words out of the way. Let's jump right in. I'm going to get my face down here a little bit. So just looking at OCGN right here, you can see that the price kind of came back up, which puts us in what I refer to as the golden zone. So if we look up here at the contracts, those covered calls, actually, let me get my face out of the way, the whole thing, just so that we can see the whole screen. So if we look at OCGN here, we can see that I bought 200 shares total, and I sold 2 contracts against them. So I sold a March 15th $1 strike, and I sold an April 19th $1 strike. This was about 30%, or I'm sorry, this one was about 30% positive yesterday, and this one was about 50%. But as you can see, the price kind of shooting back up has affected that profitability. So if we look really close, we can see that there's just a natural balance here, right? So the price went up, which means the value of the calls that I sold went up. And because I'm the seller, I want them to go down, which means I lose some profits there. Because if you look at it from the other side, the person who bought those contracts is now holding a call, which is the right to buy shares, and the price is going up. So the value of their position is going up, which means it has to come out of mine because I make the money on the downside or when the price goes flat on my contracts. But I also have 100 shares here, so I'm kind of getting the best of both worlds. So it doesn't really matter if it goes up or down. As the share price goes back up, you can see that this is now net positive by 1%. The value of these contracts is still below my the amount that I collected, the premium that I collected. So if we just look at this one here, you can see that the price has only really moved up 1% over time, which is good because it's moving up in the direction that I want it to go. But the best part about this is it didn't go up at a rate which makes me lose money. So, and by lose money, I mean lose profit potential. So in this case, right, in the case of just the second contract right here, I collected $25 when I sold this call, and I bought 100 shares at 96 cents each. So I spent $96, collected 25, which tells me 96 minus 25 is my break even for the shares. But 96 plus 25 is also my break even for the buyer to assign the contract. So if I go ahead and map out those numbers really quick, we can see we've got 96 plus 25. The price needs to get to $1.21 per share before it becomes valuable enough for the buyer of the contract to exercise it. So if you think about it, and it doesn't matter how many buyers are, selling this contract, they're passing it around. It doesn't matter because they're all paying what the contract is worth at that time, which doesn't matter to me at all because I'm the seller. So, if somebody bought that call yesterday at the discounted price and then sold it today, like say they sell it to another buyer right now, that buyer is still paying me not him, I'm sorry, not me, he's paying him $23 for that contract if it's sold right now, right? So in order for it to be profitable, it has to be above the strike, but it also has to be worth the value of the contract. So, if I spent $23 or $25 specifically, and I bought this call, the price would need to get not only above that number, but above the strike. So that tells me that if I want to buy 100 shares at $1 each and I want to exercise this contract, I need to have it be at least $1 market price, plus what I paid for the call, plus a little bit more for profit, right? Anything above that is profit. So in this case, if the contract value is now worth 123, right? Oh, not 125, 123. Okay, and the price gets up here to 123, right here. Okay, then this would become the profit threshold for the buyer, right? If somebody bought this call from someone else right now and they exercised it, this would be break even for them because the value that they paid for the contract is a deficit in their portfolio, and the 23 cents that they're gaining on the shares cancels that deficit out. Okay, now we know there's a tax advantage there, and that's cool stuff, but buyers of contracts that are looking to unload shares need the price to be up here because that's profitable territory. Okay, and that's going to change over time as the contract loses and gains money depending on who's buying it and stuff. But ultimately, if the price goes up, okay, and the price goes up above this 123, the value of that contract is also going to go up, which means this 23-cent threshold could be up to 35 cents. It could be up to $1.35 if that contract goes up to 35 cents. So anyone who buys it at $1.35 off another trader then has to wait for the shares to get above $1.35 in order to be profitable in their regard. Okay, So that's why I'm not too worried about it getting assigned around $1, right? Because the contract's value is still pretty elevated. Now, the only time this really becomes an issue is when you get closer to expiration. So this contract right here, the top one here, I sold for $15 and it's now worth $8. So if somebody buys that, they need it to be at least above $1.08 in order to become profitable, or at least break even, right? So $1.08 is the threshold for them, right? Because again, if we're just looking at it from their perspective, I'm just going to erase these other lines. If we're looking at it from their perspective, if they wake up this morning, drink some orange juice, whatever, decide, okay, I want to buy this call for $8, okay? And if it goes up over $1, I want to assign it, okay? If they assign it at 103, for example, and they've paid $8 for the contract, they'll be sitting on a $5 loss overall, right? They'll have the shares and they'll get a 3-cent increase on the shares times 100, but they would have lost the value that they paid for the contract, and it doesn't balance out enough. So they would be net negative in that scenario. So it needs to be above the value of the contract plus the strike price, okay? So naturally, as time goes by, right, the value of this contract is going to get lower, 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 or if the price sells off dramatically, but then we don't have to worry about the price coming up here, right? So the only time that this level here is going to go down is if the price comes up but doesn't exceed that rate, right? Does that make sense? So if the price goes down, this isn't an issue, okay? If the price goes sideways, this will drastically, or it will consistently lower as time erodes the value of the contract, right? And then right here, for example, that's the sweet spot that the assigners look for, the ones who exercise their contracts. They wait till the contract is almost worthless, and the price just needs to be up here at that point, and then they can exercise it. But if the price is up there, this should be up here, right? In most cases, unless it's an aggressive theta decay. So I don't have to worry about getting a sign on these unless the price is well above that dollar threshold, which is why I don't really care if the price goes up or down. So price goes sideways, I make money. Price goes up, I make money. Price goes down, I make money. And you can see here that this contract here that expires in 8 days is now worth about half from when I got it. So if I look at the trade detail, it won't show me that. Okay. I'll have to look at my orders for this. OCGN. See if I can get the March one here. I got a lot of orders here, guys. Let me just isolate it just to OCGN. Sorry. That way I'll have less to sift through. Looks like I just have... Okay, so it's not going to show me the contract value stuff. I'd have to look at my trade confirmation, and I don't want to get into all that on this recording here. It's already pretty long. So yeah, just to briefly recap here. This is the golden zone, right? Anything at or above the strike price, ideally, or at least above my break-even, right? Because my break-even is here minus the value I collected. I'm sorry, the strike price minus the value I collected. So anything basically in this zone will show me a net profit on the calls and the shares and the position overall, okay? If the share price drops down, the call value will come up. There's a defined crossover point for that, at which I will be break-even, which is, again, I can calculate very easily. And if the price goes up here, I'll be net profitable on the shares, but not the calls. And the calls drawdown, in my case, because I'm the seller, right? The value's going to skyrocket on those contracts, but the value doesn't outperform the growth in the shares, right? So that's how there's only a specific point where that's relevant. And since I'm not buying the contract back, I really don't care what the price of the contract is. And I don't really care too much about the share price either, because once it goes over $1, it's either going to get exercised or it won't, at which point I'm selling it for $1 regardless. So just a little bit of logic-based analysis here. I don't really have to think about anything. It's pretty cool once you get your head wrapped around it. So let me just kind of recap this really quick. JP Morgan's good. Schwab is good. They still haven't taken my shares for this one. I'm going to just collapse that because we kind of went over it. O is good. Main's good. Johnson & Johnson's good. Remember, I didn't buy any Johnson & Johnson because their dividend payment on that share that I would have bought is already passed. So there's no point in me spending $158 on one share. So I put that money into a $200, $100, $50 mix. And actually I currently have $200 sitting in cash. So I might get another $50 share, or maybe like 5 more ladder or something. But I also have some money to keep handy for those Neo calls. So I think I'm just going to sit on the cash for a little bit and see what it does. But yeah, so that's the logic behind it. You can see Tesla here in clip. I'm not going too much heavier in these too aggressively. I'm waiting for Tesla to kind of find a support, so it's starting to. But I don't want to buy this too aggressively. I'd rather just wait till it stops pushing down as aggressively and then catch it on the way back up. So that's pretty easy there. So let's kick it over to the 50K account just so we can take a peek at that. And you can see as well, NEO, the price has gone sideways. It's just kind of been in this range for the last 3 days. Now we had a little deviation down here, but it came back up. And it looks like it's getting ready to push again out of this box. So we've got a fib retracement zone right here. I'll just draw that for you guys real quick just so you can kind of see that. And we've got roughly sorry, I don't know why that was up here. It's supposed to be down here. But we got a pretty clean touch off that 50% level, and it's just kind of bouncing off of that. So we'll see if we get a higher high or if it retraces lower, but I feel like it's pretty well primed to go higher, so I'm not too worried about it. Either way, I make money, right? And you can see this is a $50,000 account. I've got 2 covered calls. I got 1 for NEO. I also have 26 shares just on the side because I bought them by accident. And then I have OCGN covered call as well. So if we look at OCGN here, you can see it's another scenario, right? We've got our break-even price. So I bought these at 92.29, which is just below the current price. You can see it's about a cent or so below the current price. A cent and a half, sorry. So we're about 1.65% up on that, but you can see that the value of the call has increased because of the recent volatility to the upside. So I'm at a small deficit for this contract, but again, I don't plan on buying these back, right? I just want to sell the contract for 20 bucks and then either sell the shares when it goes above $1 or just throw another covered call out there if it goes sideways or down. But we're getting into that territory where we're in the golden zone. It just has to go down or sideways just for a little bit longer, and then the value of the contract will balance out even if the share price doesn't move, or if it moves up slower than that rate of the rate of decay, right? And then that will put all 3 of these in a profitable position. Otherwise, again, if the price just goes up and I sell at $1, that's okay. I don't care. But right now, I would need the price to get above $1.20 before I even consider getting exercised. And again, I want to get exercised on these shares, so it doesn't matter. So just kind of kicking back to NEO here. Same thing, right? I collected $55 for this. My share average is 535. That gives me a defined range where the price should hang out, and it should break over 6 pretty soon, in my opinion, at which point I'll probably get assigned and the value of this call will go down. However, and here's the coolest part about all this, once this gets exercised, this contract, it goes away. It doesn't count as a net positive or a net negative as far as closing the contract. It only counts as I collected $55 to give someone else the right to buy my shares, and that's it. I don't have to buy the contract back. It just it doesn't get bought back when I close it unless I want to keep the shares. So it just disappears from my portfolio. So even though this right here, as an example on OCGN, this might show that it's a negative 250 or negative 12.5% unrealized loss, that number, that 250, will just get added back to my portfolio once the contract goes away, right? So the drawdown on this contract gets added to my portfolio value again because it's unrealized. So when the contract dissolves, essentially, when it gets when it expires worthless and goes away, it's no longer going to be an unrealized loss to my portfolio, which means the number, that big number that I might be looking at if the price somehow goes up and doesn't get exercised, it will just go away. So it's pretty cool. I don't mind seeing these red numbers on the covered calls, and that's kind of what you're going to see a lot of times when you sell these if the price goes up pretty soon. Kind of want that to happen, especially if you're wanting to sell the shares. So in this case, I want the price to shoot up over $1 pretty quickly because I just want to collect that $20 premium per contract, so $2,000, and then just be done with it. I don't want to hang out and and wait for it to expire worthless on this one. If it does, that's okay. I still keep that $20. But if the contract gets assigned or exercised and I get assigned, then this number just goes away no matter what it is. So if we look at it in terms of, let's say this shoots up from 20 cents, it's currently at 23 cents. Let's say it shoots up from 20 cents to $1.50, right? That's about 7.5, so about 750%. So it would show me really, 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 really negative at that point. And that's only because of the way it's reflected in my portfolio. So I've sold it at 20, and it would currently be at 150, which would put me down $1.30 per share, right? Or per contract, I'm sorry. So that'd be a pretty big red number in my portfolio. But again, that number doesn't matter, right? Because I'm not going to be buying those contracts back. So I know a lot of people when they start doing covered calls, they start to see that and they freak out and they're like, "Oh my God, I'm looking at all these big red losses," and in reality, you're not. It's just the way that it's reflected in the broker. So if you are someone who's just started cover calls and that panicked you, don't worry about it, because the only scenario where that's going to be a big red number is if the price goes up, and you're likely to get exercised at that point anyway. So you're probably just going to sell those shares. If the number is big and red and you're wanting to keep your shares and all that good stuff, I mean, if it's that big, you might just want to consider selling those shares and just capping your profits anyway, because then you can just buy them back and then sell another covered call in most cases at the inflated premium. So it's a pretty good kind of an airtight system as long as you're aware of the potential risks. Like if the price suddenly sells off and all that good stuff, then you can still sell underwater contracts, so it's not the end of the world. Um, but I want to make sure that nobody feels uncomfortable with the process if they see things that they just maybe don't understand. So I got to end this episode here because I realized it's about 16 minutes long. So I appreciate you guys all hanging out. I'm gonna do the live trade tomorrow morning in Market Open in the PB server. So if you're there, awesome. If not, I'll see you guys on the next episode. And thank you all for watching, and have a good weekend. Bye.